Chapter 19, Cost Management Systems, Activity-Based, Just-in-Time, and Quality Management Systems. That is a lot. So here we go, diving right in. Learning objectives. So we're going to assign direct cost and allocate indirect cost using predetermined overhead allocation rates with single and multiple allocation bases. We're going to use activity-based costing, which is ABC, also known as ABC costing, to compute the predetermined overhead allocation rates and allocate indirect cost. Use activity-based management, which is ABM, to make decisions, and use activity-based management, ABM, in a service company. We're going to describe a just-in-time JIT management system and record its transactions. We're going to describe quality management systems, also known as QMS, and use the four types of quality cost to make decisions. So learning objective 1, assigning direct cost and allocating indirect cost using the predetermined overhead allocation rates with single and multiple allocation bases. So how do companies assign and allocate cost? Product cost consists of direct materials, direct labor, and manufacturing overhead. They're easily traced and assigned to the product. You have direct materials cost and direct labor cost. They're allocated to the product. You have manufacturing overhead cost. A single plant-wide rate is called the predetermined overhead allocation rate and is calculated before the period begins. There's a traditional approach of allocating manufacturing overhead. It's the simplest method, and one allocation base is used and applied to all units. Here we have the predetermined overhead allocation rate formula. So make sure that you know this formula. But to calculate the predetermined overhead allocation rate, you're going to take the total estimated overhead cost divided by the total estimated quantity of the overhead allocation base. So as an example, we have 100,000 total estimated overhead cost and 250,000 total estimated direct labor cost, which gives us 40% of direct labor cost. The manufacturing overhead cost can now be allocated to each model by multiplying this rate by the actual direct labor cost incurred. So what if there are two departments with different allocation bases? For example, the overhead allocation base for the production department is machine hours. And the overhead allocation base for the software department is direct labor cost. The total estimated overhead cost for the production department are $80,000, and the total machine hours are $20,000. So here we've got our predetermined overhead allocation rate equals total estimated overhead cost divided by total estimated quantity of the overhead allocation base. So we're going to take 80,000 total estimated overhead cost divided by 20,000 total estimated machine hours, and that's going to give us $4 per machine hour. The estimated overhead cost for the software department are $20,000, and direct labor costs are $31,250. So here it's showing us how to calculate the percent of direct labor cost. So we have taken our 20,000 total estimated overhead cost divided by our total estimated direct labor cost, and that's going to give us 64% of direct labor cost. And this is just showing us the difference between the standard model and the premium model. So here we have the standard model. We've got our manufacturing overhead for production at $60,000, and then our manufacturing overhead for software is $14,080 under the standard model, which gives us our total manufacturing overhead of $74,080. We're going to then divide that by the number of units, which we have 2,000 units, and that under the standard model, and that's going to give us our manufacturing overhead cost per unit of $37.04. When we look at the premium model, we have 20,000 in production manufacturing overhead. We have 5,920 in our manufacturing overhead software. That is going to give us 25,920 total manufacturing overhead. And then we're going to divide that by the 500 units, which is going to give us $51.84 under the premium model. And then we can look down, you can look at the next section as well for the total cost per unit. It shows us the difference, the different breakdowns for that as well. And then here we have our analysis. So for our analysis, we've got our standard model and our premium model. And for the standard model, we've got $273.20. And the multiple department allocation rate is $275.04. And so we're going to subtract that from the 273, which is our allocation rate for the single plant wide, and that's going to give us that negative 184. For our premium model, we do the same thing, we just have different numbers. So our single plant wide allocation rate was 407. Our multiple department allocation rate is $399, and that's going to give us a difference of $7, just rounded. So learning objective 2, activity-based costing, using ABC to compute the predetermined overhead allocation rates and allocate indirect cost. How is an activity-based costing system developed? With ABM, activity-based management, it focuses on primary activities the business performs. It uses cost information to make decisions that can lead to greater profits. The activity-based costing is the process of determining the cost of the activities as building blocks for allocating indirect costs to products and services. So here we have examples of activities and allocation bases. So we've got the activity and we've got the allocation base. And so you can kind of read through these, but let's see here. For the first one, we've got quality, so the activity is quality inspection. Excuse me. And so for quality inspection, we're inspecting raw materials or finished products, and the allocation base is going to be the number of inspections. Okay, so the number of inspections is going to be the allocation base for that, which is going to be the denominator. All right, the base, the bottom. That's for all of these, by the way. The allocation base is going to be the bottom. So when we're looking at our warranty services, which is we're providing a service for defective products, we're looking at the number of service calls. That's going to be our allocation base. Okay, so when we're figuring out our warranty service for defective products, the denominator is going to be the number of service calls. And then for shipping, we're shipping finished products to customers. Allocation base is going to be the number of pounds of product that we shipped. How much product did we ship? Okay, so we're going to divide by that. That will be our allocation base. For setup, when we're setting up machines for production, the number of batches will be our allocation base. Machining, when we're using machines, the machine usage. We're going to look at our machine hours, and the number of machine hours that we use is going to be our allocation base for our machine usage. For purchasing raw materials, allocation base will be the number of purchase orders. So how many purchase orders, POs, did we put in? And that's going to be our allocation base for determining our purchasing of raw materials.
Professor, can you go back to after you said the denominator is the number of service calls, and that we're going to divide, correct?
So first, so how is an activity-based costing system developed? How do we develop this? So first, what we're going to do is we're going to identify the activities and estimate their total cost. Then we're going to identify the allocation base for each activity and estimate the total quantity of each allocation base. And then after we do that, we're going to compute the predetermined overhead allocation rate for each activity. And then we're going to allocate indirect cost to the cost object. So step 1, identify activities and estimate their total cost. So we're identifying activities used to allocate manufacturing overhead, and some examples of those activities include the quality inspections, which is inspecting raw materials or finished products, shipping, so we ship finished products to customers, setups, we're setting up machines for production, and purchasing, we're purchasing raw materials. So looking at step 1, we're identifying activities and estimating their total cost. So we have this overview of Smart Touch Learning, and we're looking at the traditional system, and we're also looking at the ABC system. So when we're looking at the traditional system, we have our manufacturing overhead, the allocation base, we've got our direct labor cost, and then for the products, we're looking at the standard model and the premium model. When we're looking at manufacturing overhead when we're looking at the ABC system, we've got our manufacturing overhead, but then we see here it's split. We've got 3 different sections. So we've got our setup, we've got activity setup, activity production, and activity testing. And for our allocation bases, we've got the number of batches, our direct labor hours, and the number of tests. And then we see here, so these can actually go to either our standard model or our premium model. So we've got, for products, we have standard or premium, and then under number of batches, you see here our allocation base number of batches can go to the standard model or it can go to the premium model. And the same with direct labor hours and number of tests. So then for step 2, we are going to identify, we're going to look at their setup, production, and testing for the ABC allocation base. So here we've got our setup is the activity. The allocation base that we're going to use is the number of batches. And then it's telling us if we're looking at the standard model, we have 40 batches. If we're looking at the premium model, we've got 20 batches. And then the total overall of all the batches is 60 batches. 40 plus 20 is 60. So then we've got production, same thing is telling us our direct labor hours. We've got 10,000 for standard. We got 2,500 for premium. And then that's going to give us a total of 12,500. And then for testing, we've got our standard model testing is 7,750. Our premium model for testing is 2,250. And that's going to give us a total number of tests of 10,000. So for this one, make a note, write this down, because you're going to need to know this formula. So here we've got our predetermined overhead allocation rate. We've got the total estimated overhead cost divided by the total estimated quantity of the overhead allocation base. Total estimated overhead cost divided by total estimated quantity of the overhead allocation base. So here we're just looking back. So on the previous slide, it told us 40 batches, 60 batches. It gave us the direct labor hours. It gave us this information on the previous slide. So now what we're doing is we're going in and we're saying, okay, so for our setup, we've got this 15,000, and we're going to divide that total estimated overhead cost of 15,000 by 60 batches, and that's going to give us $250 per batch for setup. For production, we're taking that 65,000 total estimated overhead cost divided by 12,500 direct labor hours, and that's going to give us $5.20 per direct labor hour. And then for testing, we're taking the 20,000 total estimated overhead cost divided by 10,000 tests, and that's going to give us $2 per test. So allocating indirect cost to the cost object. So this is a good slide to refer back to when performing some of your homework or practice problems. It helps to kind of break down everything. It shows you the calculations. So for instance, when we look here, we've got, this is the end result that we're getting to, right? Equals this. So to get the allocated manufacturing overhead cost, we're going to take predetermined overhead allocation rate times actual quantity of the allocation base used, and result in getting us the allocated manufacturing overhead cost. So we see the calculation here. We're taking, for setup, we've got $250 per batch times 40 batches equals 10,000. And this is how we work the problem. For each one, we just plug in the numbers, plug in whatever this predetermined overhead allocation rate is based on the previous slide, or if you're working this problem, it's either given to you or you've calculated it because that was required of the problem. So you would have this, you plug it in, and then get your allocated manufacturing overhead cost. And then we, just the whole way down working the problems. So one thing I try to mention is it's good to study, to kind of like look at these, and don't just look at these, read them and try to figure out what's going on, because when you first glance, you just see a bunch of numbers and a multiplication and an equals. But when you actually look at it and see what's going on, it's just, one number multiplied by another equals. So just, pay attention to that. All right, so traditional costing systems compared with ABC systems. Here we're looking at the standard model and the premium model. We've got our single plant-wide allocation rate, which we've got direct materials cost per unit, direct labor cost per unit, manufacturing overhead cost per unit. And then we're going to get to our total cost per unit of $273. So standard model is it's saying we've got 150 for the standard model. We've got $88 for direct labor cost per unit, and we've got manufacturing overhead cost of $35.20, which gives us a total of $273. So we can just kind of read through all of these, kind of like take note as to, you know, the difference between the standard model and the premium model. Learning objective 3, use activity-based management to make decisions. So how can companies use activity-based management to make decisions? Activity-based management uses activity-based costs to make decisions that increase profits while meeting customer needs. Activity-based management decisions include pricing and product mix and cost management. The pricing decision, if the cost per unit changes, should the selling price also change? What do you think? If the cost per unit changes, should we also change the selling price? What are your thoughts on that? Anybody care to share?
This is Laverne. I think it should change. I think it will change. If the cost of the per unit
If
changes,
we have,
then the price is
let's
going
say
to
we make
change.
pencils,
Yes.
and it cost us 5 cents to make a pencil, and we sell the pencil for 25 cents. And then the price of materials goes down, and now it costs us 3 cents to make a pencil.
Mm-hmm.
Should we still charge 25 cents for the pencil?
No.
Or should we change what we're charging for the pencil?
I think we need to change the price that we're charging.
What we're selling it for.
Yes.
Nobody?
I think it changes.
All right, let's say the price goes up. So it cost us 5 cents to make the pencil, and we sell it for 25 cents. But now it's costing us 10 cents to make the pencil. Should we still sell it for 25 cents, or should we change the price that we're selling our pencil for?
I think we need to leave the price as it was, 25 cents.
Should we change the price to 30 cents a pencil?
No.
That way we're at least capturing that extra 5 cents that it went up. Should we charge 35 cents a pencil because we want to capture that additional 5 cents and then make a little more off of it, just in case something goes wrong somewhere? Maybe we got something wrong and the price ends up being a little higher, or maybe we end up having to cover more warranties. I don't know. What do you think? If we change the price, if the price per unit to make something goes up or down, should we change the amount that we sell it for?
Yes.
These are decisions that managers make, and actually just, you know, you and I, we make decisions similar to this in our daily lives as well. That's a question that, I mean, we could guess, we could say what we think. Oh yeah, they should increase the price a little bit since the cost went up, the price should go up. And then there's, you know, we could also say, well, if the cost goes up and we increase the price, well, what if we end up losing the customers that we have because they don't think the pencil's worth 30 cents, they only want to pay 25 cents for it?
Well,
Now we're not going to sell them.
Well, don't you
we're going
think
to sell
that,
less, and we're going to make less money? So,
Well,
and then, and if you think about it, if you think about it, you know, in depthly, then you also have variable costs. You have fixed costs. You have variable costs in making this pencil, and you know those costs could then go up or down because we're now selling less pencils. So now we may have to allocate more cost per pencil or less cost per pencil. So this simple question of should the selling price change if the cost per unit changes turns into a more difficult and challenging question. So managers use all these different costing tools that we're talking about to help them make better decisions on how to price their products. So it's not really a simple yes or no question, right? We need to look at more information. When we're looking at a product mix decision, we compare the gross profit of two products and sell the product with the greatest gross profit to maximize total gross profit, considering limited production capabilities. That was a lot. So basically what they're saying is we're comparing the gross profit of two products, and we want to see which one brings in more profit. The one that brings in more profit, that's probably the one we're going to stick with, right? Because it's bringing in more money for our business. So that's all that's saying. We're comparing it. Companies adopt ABC, activity-based costing, to get more accurate product cost for pricing and product mix decisions. Value engineering reevaluates activities to reduce cost while satisfying customer needs. And cross-functional teams work together, including marketeers, engineers, production personnel, and accountants. Target pricing is the amount customers are willing to pay for a product or service. The target cost is the maximum cost to develop, produce, or deliver the product or service and earn the desired profit. The cost-based pricing is the full product cost, is the cost to develop, produce, and deliver the product or service. The full product cost is the cost to develop, produce, and deliver the product or service. Desired profit is added to this full product cost to determine the sales price. Desired profit is added to this full product cost to determine the sales price. So here we've got our cost-based pricing versus target pricing. And when we're looking at cost-based pricing, we've got the full product cost plus the desired profit, which equals our sales price. And when looking at target pricing, we've got our target sales price minus our desired profit gives us our target cost. Activity-based management, ABM, in a service company. So can activity-based management be used in service companies? So we've got some steps to develop. So we're going to use the same steps to develop our overhead rates that we used for manufacturing companies. So step one, we're going to identify activities and estimate their total cost. Step two, we're going to identify the allocation base for each activity and estimate the total quantity of each allocation base. Step three, we're going to compute the predetermined overhead allocation rate for each activity. And step four, we're going to allocate indirect cost to the cost object. Describe a just-in-time JIT management system and record its transactions. So can anyone tell me, do you recall what just-in-time is? Anybody want to take a guess at it?
Can I answer it? Hello? Hello?
So just-in-time is it's kind of like you could call it on demand in a sense, right? So with just-in-time, things are created and ready. I cannot hear you. No, ma'am. Do you have your speaker turned off?
Can you hear me now?
Yes, I can.
Okay. Laverne was
Sorry.
talking. I didn't know if you heard her or not.
No, I did not. I could not hear you. Please go ahead. I'm sorry. Excuse me. Okay. Laverne?
Yes, can you hear me?
I can.
Okay, because I was trying to answer before. When you asked for just in time, it's a cost system. It's a management system, and it's a cost system, and the company produces products at just in time to satisfy the needs of the supply of the person that's wanting the goods. Hello?
Yes. So for just in time, yeah, we're kind of it's on demand it's ready when needed, so to speak. It's basically to reduce the cost of inventory. So if um, not to have, because when you think about it, we produce things and then we have to store them somewhere until they're actually sold. So for just time, it helps to reduce the cost of inventory because we're not having to hold finished goods very long. We're creating them closer to their order time, or maybe when they're ordered. When you think of like a lot of like some of the t-shirt, there's some online clothing companies that you can only order the clothes online, and that's because what they do is you place an order for a t-shirt, and when you order that t-shirt, that order then goes to the t-shirt manufacturer to print the logo on the shirt that you have chosen, and then they ship it out. So it's kind of like an on-demand, just in time. They have no overhead they have no inventory cost. And your raw materials and your finished goods, hold on, actually I think it's on the next slide. So just-in-time management systems, they reduce your inventory cost. Your raw materials and finished goods are completed just in time for delivery to customers. And the cost of buying, storing, and moving inventory can be significant for companies. So it just helps to save on that cost as well, because you have less cost to incur. So how do just-in-time management systems work? All just-in-time workers perform materials handling, assembly, and quality control functions. So we've got the worker, we've got our raw materials inventory. So we've got raw materials inventory, it goes to the worker. The worker transmits information via their cell phone to another worker. Then eventually the item ends up in the finished goods inventory, and that is just in time. So it really just kind of like goes around this quick little circle. Raw materials to the person, finished goods. So raw materials to finished goods. In a traditional production system, you've got your raw materials inventory. It goes to your materials handler. Then it goes to, various assembly workers. It could go to one assembly worker. It could go to multiple assembly workers. And then you also have a supervisor that supervises that process normally. And then once it's gone through the assembly process, it then goes to the materials handler. Then it's quality control inspected. And finally, it ends up in your finished goods inventory. So there are several more steps that take place when you're looking at the traditional production system versus the just-in-time production system. So just-in-time costing, it's a costing system that simplifies accounting for companies. They track cost after the units are completed. They combine raw materials inventory and work-in-process inventory into raw and in-process inventory. The conversion cost account combines direct labor and manufacturing overhead cost. Comparison of traditional and just-in-time costing. So we have our traditional costing and our just-in-time costing, and we're going to look at the production activity, inventory accounts, and manufacturing cost. So for our production activity in a traditional costing, we're going to record the cost of products as they move through the manufacturing process. With just-in-time production activity, they record the cost of products when the units are actually completed. So for traditional, we're recording cost as they move through the process. Just-in-time records the cost when it's done. For inventory accounts, in a traditional setting, we have our raw materials inventory, our work-in-process inventory, and our finished goods inventory, which we saw on that previous slide. The multiple areas of assembly line that the traditional production system runs through. We saw raw materials. We saw, we didn't see a work in process, but the assembly worker, that would fall within that work in process because they're working to put it together. They're working in process to finish it. And then when we got to the very end, we saw the finished goods inventory, which is where we have, our finished goods listed. So traditional inventory accounts, we've got raw materials, work in process, finished goods. For just in time, we just have our raw and in process, and then we have our finished goods inventory. So less accounts there as well. And then when we're looking at our manufacturing cost, for a traditional setting, manufacturing cost consists of direct materials for both traditional and just in time. But then for traditional, we have our direct labor manufacturing overhead. And so you think back to the assembly line workers, the supervisor, quality control specialist. So we've got our direct labor manufacturing overhead for traditional. But then for just-in-time manufacturing cost, they have direct materials conversion cost. So they are looking at the direct materials conversion cost. So here we're going to look at some journal entries. We are recording transactions in just-in-time. So here we've got Smart Touch Learning purchased 305,000 raw materials on account. So we are going to debit our raw and in-process inventory because we're looking at just-in-time, right? So when we saw on that previous slide for just-in-time costing, we saw that it says for their inventory accounts, for just in time, they use raw and in-process inventory. So if you have a question where they're asking you to journalize and they're telling you that the company uses just in time and they purchased $305,000 in raw materials, you're going to debit your raw and in-process inventory. It is not raw materials inventory. For just in time, it is not raw materials inventory. So make note of that. Come back, look at this slide. This should help you as well with that. Just keep in mind, like, read the question through and through. So for just in time, you're looking at raw and in process inventory. And if you, I think it's slide 36. Yep. So slide 36, that's where you'll see all that. So you see here, they distinguish between the two: raw materials inventory, raw and in process. And you also need to, pay attention to the other ones as well. But that's probably the most frequent mistake that I'll see is people just read through it too quickly, don't realize that it's for just in time. Or, the two accounts do sound similar, so raw materials inventory, raw and in process. So just make sure you can distinguish between the two so that you, answer that appropriately. So this is this journal: debit raw and in process inventory, credit accounts payable, because they purchased it. How? Why is this not cash? Or what would make it cash? Want to take a guess at either one of those? Why are we crediting accounts payable? What tells us to credit accounts payable?
We credit accounts payable because it's not cash and it's not a finished product.
Because it's on account. It's not cash, it is on account. Good job. So we're putting it in the accounts payable account because we still owe it. We got the materials on account. So we have to record that we still owe that money. Good job. So here we have the Smart Touch Learning incurred $255,000 for labor and overhead. And we've got here, to record that, we show we are debiting our conversion costs and we're crediting our wages payable accumulated depreciation account. And then we've got in transaction 3, Smart Touch Learning completed 2,000 standard model tablets that it moved to finished goods inventory. The standard cost of each tablet is $276.75. That is $150 in direct materials plus $126.75 in conversion cost. So we're going to debit our finished goods inventory and credit raw and in-process inventory, and we're going to credit our conversion cost. And then here for transaction 4, we've got Smart Touch Learning sold 1,900 tablets on account for $500 each for a total of $950,000. The cost of goods sold is $525,825. And we have that. We've got 1,900 tablets times $276.75 gives us our cost of goods sold. And then we see here they debited the accounts receivable account and credited sales revenue for that total of $950,000. And then they debited cost of goods sold and credited finished goods inventory for the $525,000. So here we've got Smart Touch Learning's just-in-time costing accounts. So here we're looking at the balance sheet on the left and the income statement on the right. And these are the T accounts. So we're looking at, under the balance sheet accounts that we're looking at are raw and in-process inventory, finished goods inventory, and conversion costs. Those are all balance sheet accounts. And then these are the T accounts for those accounts. Did somebody say something?
No.
Okay, I thought I heard somebody apologize. So these are the T accounts for the three different balance sheet accounts that we're looking at, and then we have the T account for our income statement account, which is cost of goods sold. So for raw and in-process inventory, this is just showing us, so if we look back a few slides, let's see, we've got our raw, what's going on here? We've got our raw and in-process inventory, beginning balance of $20,000, and then we had a transaction 1. So if you go back to transaction 1, that's where we see that journal entry where they purchased the 305,000 raw materials. So when they made that purchase, we had to debit that account for 305,000. And so when we debited that account for the 305,000 for the raw and in-process inventory, and then if you go down to transaction 3, we also had to make a credit to that account. So on transaction 3, we credited the raw and in-process inventory, and that's because we had completed some standard model tablets that ended up moving to finished goods. So we credited the raw and in-process inventory account for the 300,000. And then we total those out. So we take the beginning balance plus this transaction minus that transaction, and that gives us our ending balance of $25,000. And that's how we did the T accounts for all of these accounts. So you can kind of like go through and compare the T accounts to the journal transactions that we just covered, to watch that flow and how they are set up in the T accounts.
Can I ask a question on the raw and in-process inventory with the balance that was $20,000 and that first transaction? Did they divide the transaction? I mean, how did they come up with the balance of 25,000?
So that's just, so all the beginning, so the beginning balancers are given.
I'm sorry, say that again.
The beginning balance is given in the T account.
Okay.
So here, the screen that we're looking at right now, they had to give us a beginning balance in order to give us an ending balance. So they put the beginning balance in as 20,000 for the raw and in-process inventory. In the previous slide, for example, when we did transaction 1, we did not need to know what the beginning balance was to calculate that 305,000. So you won't see that 20,000 there. But here we see, because they had to give us a beginning balance. So that would be something that would be given to you. If you saw it on your homework or a test rates or anything like that, you don't have to calculate that. There's nowhere for you to calculate that 20,000. It would be given to you.
Okay. I guess I was just trying to figure out, how did they do it? Did they divide, multiply?
So you've got the 20,000 plus the 305 would be 325. And that's on your debit side. So you've got 325, but then you had a credit of 300, so you've got to take that credit out.
Okay.
So when you take that credit out, that's going to leave you with 25,000, and the 25,000, it could be on the left-hand side or the right-hand side. It's on the left-hand side in this account because that's the side that is greater.
Okay.
And it just so happens that all of the T accounts in this example fall on the debit side. But we can look, so when you look at, so when we're looking at the conversion cost, we see they have transaction 2, they have 255,000 in a debit, and then they ended up having another transaction that was a credit of 253,000. So we take the 255 minus the 253, and that gives us the 1,500, and that 1,500 goes on the left-hand side because the left-hand side is greater. The 255 is higher than the 253, so it'll go on the left-hand side, the debit side.
All right, thank you.
No problem. I know you're adding and subtracting the left and the right. I'm like, what? We learned how to do it up and down, people. So it's just a little different, but you'll get the hang of it. And like I said, just, check back. If you kind of like just go through, just look to see how they added and subtracted here to get that 25,000 or that 1,500 or 42. The more you look at it, the better you'll get at it. So here we've got, we're looking at adjustment. So we've got the actual conversion costs incurred were 255,000. The amount of conversion cost allocated was 253,500. The difference is $1,500. So they have this adjustment. To record the adjustment, we're actually going to have to go in, we're going to debit our cost of goods sold account, and we're going to credit our conversion cost for that $1,500. And here we've got, we are just kind of looking here at the adjustment for the conversion cost. This is a T account. So when looking at this T account, we have that 255,000 debit, and then we had a credit for that 253,000, which gave us the unadjusted balance of 1,500. And then we have to zero this account out because it's a temporary account. We're zeroing this account out. So when we zero this account out, we're going to, since we have a debit of 15, right here, since we have a debit of 1,500, we got to bring this to zero. We're going to have to credit this account to make it zero, and we're going to credit it for the same amount, 1,500. And when we do that, we have to record that adjustment over here in cost of goods sold. So in cost of goods sold, we've got the debit for 525, 825. We're going to record the debit for 1,500 because if you have a credit, you have to have a debit. You got to balance it out. So we're debiting this cost of goods sold account for 1,500. And that's going to end up giving us the balance of 527, 325 in our cost of goods sold account. Describe quality management systems and use the 4 types of quality cost to make decisions. system that helps managers improve the business's performance by providing quality products and services is called a quality management system. The goals of quality management systems are to improve performance, increase customer satisfaction, and increase profits. The 4 types of quality cost are: you have prevention, appraisal, internal failure, and external failure. So prevention, appraisal, and failure cost. And then with failure cost, you've got internal and external. So with prevention costs, these are costs that you incur or a business incurs to try and avoid poor quality goods or services. You don't want poor quality goods or services, so you're going to spend money to prevent that from happening. Okay, maybe you pay an extra employee to check everything before it goes out and on the shelves to ensure that it's free from defects. So that could be that would be a preventative cost. An appraisal cost is a cost incurred to detect poor quality materials, goods, or services. An internal failure cost is a cost incurred to correct goods or services before you deliver them to the customers. External failure cost incurred after you deliver to the customer. So that's after it's been delivered. So 4 types of quality cost. We've got prevention, appraisal, and failure, internal and external. With prevention cost, you can think of employee training. So, one thing that I've noticed, I feel like a lot more companies are doing, or at least ones that I have been able to kind of work with and consult with, is it seems like more companies are willing to train their employees. They want to train their employees. They see the value in training their employees. And when you train an employee, that helps them. I'm just like the reason that we go to school, right? So we're in school, and we may know some of the stuff that we're learning, but some of the stuff we may not know, or we may learn how to do it a different way. Maybe that different way is better or worse. Maybe it saves us time. So training, same thing, employee training. We're training our employees to ensure that they can do what it is that that they're hired to do, and hopefully as efficiently as they possibly can, because we're trying to give them the tools to do that. Evaluation, and also, if you're trained well on something, there's less room for error or mistake. You're less likely to accidentally leave a button off a shirt. If we're creating products, we're talking about, catching things before, if we're making t-shirts and we accidentally leave a button off the shirt, well, now that shirt is, defected. So training is a big deal. Evaluating the quality of our suppliers' processes, and preventative maintenance on equipment. So this is where instead of waiting for the equipment to just break down and then having to figure out what's wrong with it, we, kind of like your car and getting an oil change or tires. And I'm terrible at this, by the way. But preventative maintenance, it's where they are, trying to make sure that they do whatever they can to not have, like the example with the car. I'll use me as an example. I'm terrible with preventative maintenance. I will drive it until I get a flat, and that's what I did not too long ago. I knew I needed new tires. I just didn't want to go sit somewhere for 3 hours while they got put on. So I waited and waited and waited until it was flat. And the sad part about it is it costed me a lot more, because then I had to have it towed. So I should have followed up with, I should have done that preventative maintenance, right? And just went ahead and got those tires changed. But I didn't, and it ended up costing me more money. And the same types of things happens with with companies. So if this preventative maintenance on their equipment, if they are keeping their equipment, maintenance, then it works properly, hopefully. But if they wait till it stops working, it's not only stopping the equipment, it's stopping production, or it could be, because let's, think of it as being the only t-shirt printer, and all of a sudden they can't print any shirts until they get this thing fixed because it's the only one they have. So definitely keeping up with preventative maintenance. Appraisal cost, this is inspection at various stages of production. So they're inspecting it throughout the stages of production. And they're also inspecting the final products as well. And there could even be some product testing involved. So, trying on the t-shirts, making sure that they fit appropriately, making sure the buttons button correctly. Like when you think about it, when you're buttoning something, there is a little hole that you're having to stick that button through. I have bought shirts before where that little loop that the button goes through was too small, and I had to carefully use some scissors to kind of open it up without praying that I didn't end up tearing the whole shirt up, So, they have product testing as well, and that is all happening prior to the customer getting the material, because they want to make sure that the product is, as good as it can be. Then we've got our internal and our external failure cost. So with internal failure cost, any production problem that causes manufacturing to stop, anything. So, kind of like going back to that preventative maintenance. Machine broke down, everything stops. Reworking of standard products. You have some rejected products. So anything that makes the production stop, that's an internal failure. With external failures, you've got, so we sent out those shirts that were missing buttons, and we, sent the ones out that were sewn together too much, and now we're getting unhappy customers. Our customers are not happy because they're not happy with the product. They're missing buttons and they can't wear it when they get it. So we're losing customers because they don't want to buy from us anymore. They're tired of sending everything back. We also have warranty cost involved with that, because if we have a defective product, we have to cover fixing it. So, normally you have, we might have a warranty on it. Let's say it's an electronic. We've sent out a bunch of cell phones, and half of them are not working correctly. So they're under warranty. Now they're being sent back to us, and we're having to cover that warranty cost, which is, not something that we want to do, but we have to as a business. The service cost at a customer's site. So in some cases you may have a position where you go out and you service the customer at their home or their business or whatever it is. Maybe you sold a washing machine and the washing machine isn't working properly, so you have to send a service tech out there to figure out what's wrong with the washing machine. That costs money as well. Now you're having to pay the tech for his time, any parts that might be involved. And then sales returns due to product defects, which we kind of mentioned earlier, but products get returned, and at the end of the day, you don't want that. You want to sell and make money off your products. You don't want defective products being sent back. So in this example, we've got our quality improvement programs. This is small, so let me see if I can pull it up on this other screen. All right, so we've got analysis of Smart Touch Learning's proposed quality improvement program. They're going to undertake the quality improvement program. So here, just look over this slide. Let's see. So look over this slide. So we've got there for prevention. So they've got these 4 different areas, and they've got them listed out on this sheet. So they have their preventative measure, and for their preventative measure, they're saying, okay, we're going to re-engineer to improve product quality, and we're going to put $750,000 in that. And then we have this preventative maintenance of equipment, because we want to make sure our equipment is up to par and it's not going to, break down on us. So we're gonna put $100,000 in an account for our preventative maintenance of equipment. And so we expect our total prevention cost to be $850,000. And then for our appraisal, we're inspecting our raw materials. We're going to put $100,000 in that. We're going to put $150,000 in our finished goods inspection. That's going to give us a total appraisal cost of $250,000. And then the total overall for our quality improvement program is going to be the total of the prevention cost and the appraisal cost. So the total cost of undertaking the quality improvement program equals total preventative cost plus total appraisal cost. Write that down. Okay, and so that's going to give us the $1,100,000. If they don't undertake the quality improvement program and they end up having internal or external failure, this is letting us know, okay, so they have internal failure. So we're going to say the cost that we have to rework this, we have to remake the shirts, we have to redo whatever it is that we're doing. We expect that cost to be $250,000. So our total internal failure cost is going to be $250,000.
Professor, can you just repeat what you said? The last part where you said write it down. I got some of it, but I didn't get all of it.
So just right here. So this is an equation. So the total cost of undertaking the quality improvement program equals this plus this. So the total cost of undertaking the quality improvement program, that equals the total prevention cost plus the total appraisal cost.
Okay, thank you.
No problem. So we expect our internal failure cost, if we have to rework it, to be $250,000. For external failure, we have, if we have a loss of profits due to unhappy customers, we are thinking that might be $800,000. Sales returns, people are returning their products, we think that might be $50,000. Warranty cost. So we sold a bunch of phones, half of them didn't work, and people are sending them back saying, hey, it's still covered under warranty, but it's not working properly. We expect that to be $100,000. So we're going to add all of that up. The loss of profits due to unhappy customers, the returns, and the warranty cost. And we're saying, you know what, we expect the total external failure cost to be $950,000. So again, another one of those, write this down. This is also an equation. So the total cost of not undertaking the quality improvement program, so the total cost of not taking the quality improvement program is $1,200,000. And we got that because we took total internal failure cost plus total external failure cost equals the total cost of not taking the program.
Say that one more time, please.
The total internal failure cost plus the total external failure cost equals the total cost of not undertaking the quality improvement program.